So is it really easy to make money in the stock market? Let's answer this question with an example of $342,000 lost in one of the best bull runs of all times. Hey, it's Dario and this is Divity Trading, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. I see many videos and articles talking about how easy it is to make money in the stock market, or more in general, trading. You know, strategy for forex there, strategy for stock market here, how to make money fast with the stock market, and so on. But is it really easy to make money in the stock market? Is it truly impossible to lose money? I don't think so, and in this video we're going to see an example. But hey, before we start, if you enjoyed the video, please leave it a like and let me know in the comments down below what are your thoughts on this subject. Do you think it is so easy to make money in the stock market? So this is a person who lost $342,000 in the stock market from an initial capital of $474,000 with a loss of 72%. But how much is it a 72% drawdown? Is it a high loss or a small loss? Well, to know this, we just need to calculate how much we need in order to get back to zero. And this gentleman here needs his portfolio to make 255% in gains in order to get back to zero. And do you think that a portfolio that makes a minus 72% can make a plus 255%? I don't think so. But even if the portfolio could make a 255%, how many years would it take? For how long do you have to keep your money locked in that position in order to hope that eventually the portfolio is going to make a 255%, to go back to zero? Not even a gain, zero. So let's see what mistakes this gentleman did so that we can at least try to avoid them. Because you know, even though stocks are one of the best ways and safest way to invest your money, it doesn't mean you cannot lose. And it doesn't mean that it's easy. So one of the biggest mistakes that this investor did is not researching the companies that he wanted to invest in. It might seem a stupid rule because, you know, who doesn't research a little bit before buying anything? Well, it seems like this rule applies only when buying a new iPhone and not with stocks. As we see from the picture, most of the companies he invested in are companies with really bad fundamentals, companies that don't even have positive earnings and have decreasing revenues. But why did he invest in these companies? Well, the reason is simple. These Italian companies are companies that are well known in Italy, and I don't want to say they are famous, but they are almost like the Amazon, the Apple or the Ford for the Americans, but with way worse fundamentals. And so the investor probably thought that because he knew the company, it was a good company, but actually that rule doesn't really work well. Another reason might be because of the low prices of the stocks, he thought that the price couldn't get lower. Unfortunately, that's not the case. A price of a stock can get lower until the company dies. And this is a big mistake that many people do. The stock market is not the grocery store. You cannot go there and buy something that it's on sale because tomorrow it's going to expire. It doesn't work that way. You need to buy companies that are healthy and have a perspective that it's positive. For example, let's take Tiscali. This is a company which couldn't even make a cent of profit in the past 5 years and even more. It's full of debts and has a negative net worth. That means that even if the company sold everything they had, they wouldn't even cover the losses. Do you think that this is a company that investors would like to buy? Of course not. And what happens to the price action? It jumps 99%. So you basically lost everything you put in this company. The second biggest mistake that people make is not watching the charts. I know that out there are people who are just focused on fundamental analysis, but still, the charts are important. You should always look at the charts. And if the price action is falling, it's probably going to keep falling. That's one of the principles of technical analysis. It's more probable that the price action keeps doing what it's doing instead of changing its direction, and in this case, getting lower. To make it simple, if the price action of a stock is going down, why do we want to buy it? what do you think it's going to change tomorrow? And here we can see another problem with investors who don't know what they're doing. They always say that this time it's going to be different. This time the price must go higher. Well, that's nonsense. The prices don't have a certain amount of time that they can get lower. As I said before, they can go down until the company is out of game. And this connects to the fourth mistake that wannabe investors make. They don't cut the losses. You have to think about your portfolio as a company, your company, and the stocks as your employees. What happens if you have an employee that doesn't show at work that it's bad performing and that it's disrespectful towards the job? You fire him. So do the same with stocks. If you see a stock that keeps going down, that keeps getting you losses, you just cut the loss and sell the stock. On the other hand, if you have a stock that is well performing and that it's increasing its value day after day, you might want to consider increasing the size. But so, what is an example of a company that could be bought and that has a good perspective in the future? Well, let's take Nvidia for instance. We see that the revenues keep growing. We see that the earnings started to increase exponentially in middle 2016, and so what is the price action doing? Increasing. Now, I'm not saying that you should only look at revenue and earnings. There are other factors to take into account. And also, I'm not saying that you should buy Nvidia. This is just an example. What I am saying is that the risk of loss can be dramatically decreased, even just by looking at these two factors. And hey, these were my thoughts on whether or not it is easy to invest in the stock market. And as you saw, it's not that easy. But hey, if you enjoyed the video, please leave it a like and let me know in the comments down below what are your thoughts on this. And I'll see you in the next video. So how does an ETF work? What is an ETF? But also, who should buy ETFs? Well, since ETFs are instruments that are created in order to follow a specific index, so a collection of assets, they are very good at lowering the risk and the volatility of the single asset.